following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
Wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Brought to you by Zecco. Zecco is quite possibly the best value in online investing, offering a fully featured stock and options trading experience, spectacular customer service, and tons of free tools at pricing that is 30 to 50% less than the big guys. Keep in mind, options involve risk and are not suitable for all investors. Please read characteristics and risks of standardized options. For more information, including special offers, options education, and disclosures, visit Zecco.com/bootcamp. Now, let's start getting you into peak options trading shape. Here are your Options Bootcamp trainers, Mark Longo and Dan Passarelli.
All right, and that music means it's time once again for Options Bootcamp, the show where we break down raw options recruits and rebuild them into seasoned options veterans. My name is Mark Longo from the OptionsInsider.com, as well as the old Options Insider Radio Network that many of you are enjoying this fine program on right now. And I am joined on the old Options Bootcamp team by none other than my co-host, my partner in crime, the yin to my yang, good old Dan Passarelli from Market Taker Mentoring. Dan, welcome to the program.
Well, thank you, Mark. It's always good to be here.
Do you have your whistle and your drill instructor hat on, sir? Are you ready to dive into our basic training?
Sir, yes, sir.
This is going to be a good one today. I'm looking forward to it. All right, so with that, we're going to dive right into our basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in, prepare to learn. Yes, sir.
And welcome to Basic Training. This is, of course, the portion of the show where Dan and I take you raw options recruits and begin the process of molding you into seasoned options veterans. And Dan, you know, it's been a long, strange trip since episode 1 here on Options Bootcamp. Hard to believe that just a few months ago, you and I first stepped onto this training ground here, and we began the process of instructing these raw options recruits with simple things like what is a call, what is a put, and moving on to things like the Greeks, and then buying options, and then selling options, and then spreads. And now here we are, Dan. I never thought we'd get here, but here we are on the day when we're talking about complex spreads. How excited are you, sir?
I have got ants in my pants to talk about this, man. This is really exciting.
Well, you know, we're both pretty excited because this is really complex spreads in general, but complex spreads in particular are really where the rubber hits the road from an options perspective. You know, this is where options as a product truly come into their own and really begin to differentiate themselves from just buying a stock or trading a number of other different financial products. The level of detail, the level of nuance, the level of intricacy that is available to you as an options trader truly is amazing. And it is through utilizing strategies like some of the ones we are about to talk about that you really get to experience options at their fullest and put their full power to work for you. Now, what do we mean by complex spreads? We're not just saying these are ludicrously complicated spreads that are impossible to fathom. That's not really what we mean, although some of these spreads can become somewhat intricate. But what we're really talking about is usually multi-leg spreads, 2, 3+ leg spreads with various different attributes that require a fair bit more attention than a typical spread. They could be tied to stock. They could have ratios. They could have a number of other components, gamma versus volatility, a lot of other interesting things that really separate, like we said, options from other products, and also are an extremely, extremely powerful tool once you get a handle on how to really implement them into your portfolio. So, Dan, there are so many places we could start with complex spreads. I have a number of ideas, but I'll toss it to you today and give you pride of place in picking where we start here in the land of complex spreads. So what should we talk about first?
Well, Mark, last time on the last show, we started to talk a little bit about calendars. And calendars are pretty powerful and pretty important spreads. Basically, a calendar is just simply when you buy a call, or a put for that matter, and then you sell a call or put that has the same strike price, but in a different month. So that's kind of the baseline for a discussion about calendars, but they can get more complicated. We can go into what's called a diagonal, which is a combination of, a vertical spread and a horizontal spread, if you will, where we have 2 different months, just like we do with a traditional calendar, but we can also have 2 different strike prices. So now, if you're pretty new to options and you're not familiar with this kind of thing, it can kind of start to make your head spin a little bit if you're not careful. One of the most basic things that you can do with a diagonal, and probably the best way to explain them to make them really understandable, even for somebody who's a novice at trading, is to think of them sort of as a proxy for a covered call. A covered call is the most basic option strategy out there. You just buy stock and you sell a call against the stock. Well, what you can do with options to get a little bit fancier and to talk about the first complex spread we're going to talk about today is, instead of buying the stock, you go out and buy a call, an in-the-money call, as a stock substitute, a call that has maybe a couple or a few months until expiration, and then you sell a call just like you would do with a traditional covered call. You sell an out-of-the-money front-month call that has that high rich theta. So the advantages of the diagonal over a covered call are you have less cash at risk. Instead of going out there and buying the stock, you're buying a call that has way more limited risk than the stock would, but you still get that advantage of that high theta option, selling that short-term option and treating it really just like a call to generate some income on a bullish option play.
Yeah, there's a lot of interesting ways that you could play with that whole covered call formula. We mentioned a couple of shows back about some of the mistakes that a lot of options traders make when they're implementing covered calls. One of them is, of course, that they focus on writing long-term calls and not maximizing that theta that we've discussed so many times on this program. And the strategy you just outlined is a perfect example of ways you can turn that on its head and take advantage of theta in both directions and save yourself some money in the process. You swap out for example, instead of buying the stock, you buy that deep long-term call, and then you write the very very near-term call against it, collect the theta on the near-term call, and avoid paying extreme theta on the longer term call. At the same time, you've saved yourself a lot of money by not outlaying all that money to buy the stock, and you also give yourself a lot more Greeks in your favor than just owning the underlying. If the underlying drops, of course, if you own the stock, you're just losing money. But if you own an option position, the volatility is going to increase, and so the option will benefit from that. You won't lose as much. You have a delta that will decrease as the underlying drops. So there's a lot of factors that come into play when you're using, let's say, a leap versus a covered call as ways to maximize that particular position. But that's just one idea, one way of using diagonals. And of course, like we said on the last show, we talked primarily about verticals on the last show, vertical call spreads, vertical put spreads, and we teased the idea of calendars or diagonals. And that's really, they're not complex maybe in terms of the number of legs. Typically, they're two-legged spreads like a simple vertical, but they become complex from the standpoint of the different Greeks that are at play in your typical calendar. And, there's always that dynamic, Dan, of Vega versus Gamma, and that's the trade-off that a lot of time spreaders really have to deal with on a regular basis. So if you're going to be diving into the realm of time spreads or diagonals or anything that involves those two different components, then those are the two Greeks that really you need to look at, and of course theta obviously being the offshoot of Gamma or vice versa. But Dan, when you're looking at calendars, let's start there then. Let's start at that basic level then of, let's say you just did the diagonal. Let's walk through a few more examples of calendars and how you tend to play off that balance of wanting to be long vol perhaps, but not wanting to be incredibly short Gamma, and all of the inherent trade-offs that are involved in those trades.
Right. The funny thing about calendars is, on the one hand, you look at the net position. And right now I'm kind of deviating from the diagonal that we were talking about and just talking about a straight calendar. The thing about calendars, Mark, is you end up with a net positive Vega position for sure. And that is, that's kind of evident. You just look at it and you see, you see a positive Vega. But you know what, man, that can be kind of misleading, because the way I look at calendars is it's kind of the old buy low, sell high, but kind of doing both at the same time. You're taking a position in two options that are absolutely related to each other, but they are two different options because the months are different. They could have different volatilities. And, volatilities, guys, for those of you who might watch some of the other radio shows that the Options Insider hosts, volatility is really important. That tells you basically how cheap or expensive options are. I mean, the way arbitrageurs look at it is, that's the price of the option. So what you can do with the calendar is you can buy that long-term month at a cheap implied volatility level, and at the same time sell that front month at a higher, more expensive implied volatility level. So then what you're really doing is you're buying low and selling high at the same time. And the goal is to watch them converge. Usually you're looking for that front month implied volatility to come down and meet the back month. But sometimes it works just fine too if the back month volatility rises and comes up and meets the front month. So, what I'm saying here, and this is why I say that Vega can be a little bit misleading in calendars, is because you can have a positive Vega position and you can see volatility fall and still make money on volatility. It depends which month falls. And usually that front month, which you're generally expecting to fall when you do a calendar in this nature that I'm describing, generally the front month is more sensitive. So when that short implied volatility month comes down, even though you're long Vega, you can still make money on Vega.
Dan, there's so many things to discuss in this broad topic of complex spreads that I want to get to all of them. Of course, we won't be able to on this one program or this one segment of one program even, but there's so much to hit on. Another popular topic that we like to discuss whenever we're talking about complex spreads is, of course, that concept of the ratio. It's a very popular concept, often misused, quite frankly, by a lot of retail traders who see it as just a way to make a premium outlay into a premium neutral or even a credit trade, and so they take advantage of that ratio concept, and it usually comes back to haunt them sometimes if it's done inappropriately. But let's talk a little bit about what we're talking about here, which is, of course, we talked last week about basic spreads like your simple vertical buy one call, sell another call a few strikes higher up. Typically that is done on a 1-to-1 level, a 1-to-1 ratio, where you buy one call, you sell another call against it. But what happens in these ratio spreads is, as the title implies, people begin to play with that ratio a little bit. Typically, it involves selling more than the call that you bought. So let's say that typical vertical call spread example we've talked about in the past. Let's say you see a vertical call spread in XYZ stock and it's trading for $1. Now you can look at that spread and say, I could buy that for $1. But then you realize, well, wait a minute, these 105 calls are actually trading for 50 cents each. And so now if I sell two of those, I can and change that ratio, and all of a sudden my outlay is now going to be 50 cents. And now if I sell 3 of those, all of a sudden now I'm doing this spread for essentially no premium outlay whatsoever. And so you can start playing with those ratios, playing with those strikes, and find a way to, if it's done properly, to dramatically reduce your premium outlay and also increase the potential payout for the spreads, and also make your capital much more efficient from a trading perspective. And of course, as we hinted at earlier, if ratios are done the wrong way, if they're just done as a way to say, hey, I really see a way that I can put this trade on for free without really taking into account the Greeks and the risk of that position, then of course you could end up losing dramatically more money than you put in. Of course, with that simple vertical spread, your risk was limited to your outlay to that trade. With the ratio, once you begin blowing past that short strike on the upside, that 105 strike, your risk increases dramatically. So that's something also to keep in mind when you're trading ratios. And Dan, I know you love ratios just as much as I, and you have a lot of different ways that you implement ratios. What are some of your favorite ways of implementing ratios?
Yeah, Mark. Well, the way I don't like to implement ratios is just to go ahead and throw on a ratio, buy a call and sell 2 calls. That's just a disaster waiting to happen. But there is one way that I love to trade ratio vertical call spreads under the right set of circumstances. If I own a stock and the stock goes against me, it falls maybe 10, 15, 20%, and I'm thinking, oh man, I wish I could just get my money back. You can use a ratio vertical call spread as a bona fide repair strategy. Here's how it works. Say you have a stock that fell from 100 to, you bought it at 100, falls down to 80. What you can do is you can buy the 80 strike calls, those at the money calls, with about, 3-4 months until expiration, and then sell the 90 strike calls halfway between where the stock is now and where you bought it. You sell 2 of them. Now, usually when you do this, you're going to end up with the options being pretty well cash neutral. Maybe you pay 6 for the 80 calls and you sell 2 of the 90 calls at 3, for a total of $6, 0 cash outlay. Here's why you do that. Because if the underlying stock rises up to 90 over that 3 or 4 month period, just halfway from where you bought it, guess what happens? You get all your money back. And the way that works is that, of course, if the stock rises from 80 to 90, you make back $10 on the stock, but you also own the call at 80. And that's, for all intents and purposes, long stock. I mean, you can exercise that 80 call and buy the stock at 80. So there's another $10. Now, if the stock gets up to 90, great. Or if it even falls a little bit short of 90, fine. You get to keep that premium that you sold those 90 straight calls for. And if the stock goes a little bit above 90, hey man, that's fine too. Because those 90 strike calls get assigned and the original 100 shares that you owned at 100 get sold off. And the new shares that you bought at 80 from the calls get sold off, and you're left with no position, and you're indemnified. Stock only had to retrace half of its movement for you to get made whole again, for you to get all your money back. So this is what I call the stock repair strategy. And when you use it right, man, under the right set of market conditions, this is one of the best strategies that you can have in your arsenal of different types of option strategies.
Yes, and Dan, that's a great example of how the power of options, we've discussed many times on the show in the past how useful these products can be and how they often get mislabeled as these very dangerous, risky types of products when, in the example you just highlighted, people can see the utility of these products when they're implemented correctly. And, that's another example of, we talk about complex spreads and people get scared off by the idea that, these are going to be ridiculous 17 by 6 by 4.5 ratio vertical condor swaps and in the SPX, and I'm not going to be able to follow any of this. And that take that term complex spreads, take it with a grain of salt. It's a very broad term, and it implies a lot of different positions, including the simple ones we're talking about now that are a little bit beyond your typical vertical call spread or even diagonal call spread, but still are relatively easy to grasp and have very, very powerful impacts. And, speaking of positions that are simple to grasp yet can have a very powerful impact, another one of my favorite of these types of spreads is the old risk reversal and the ratio risk reversal, and a lot of interesting things that you can do with those positions. And we've talked on previous shows about using a short put as a proxy for a limit order to buy a stock. A very straightforward example. We've run through it a number of times. If you're confused, by all means, go back and listen to some of our early episodes where we talk about selling options and using short puts for that. Now, if you take that position you just used, let's say XYZ stock is trading at 100 and you decide you want to sell that 90 put and work that 90 limit order for 50 cents. Now you've done that and you collected 50 cents. Now you turn around and see that the 110 call, not $10 out of the money call, is also trading for 50 cents. And so you can put that spread on for, in this case, a premium neutral, a cash neutral position. And you've essentially legged into a bullish position on that underlying for essentially no outlay. And so that's one very simplified example of what you can do with a risk reversal. If you see an underlying, for example, that you really like and have a bullish outlook in it, you can implement that. You can do the other way. You can sell the call and buy the put and implement a bearish position on the underlying, and you can take those positions and play with them in a number of interesting ways, including ratios and including ratios on the calls, ratios on the puts, and doing a lot of interesting things to really make those positions more uniquely suited to what you're trading. Now, Dan, I know you're a big fan of the risk reversal and the ratio risk reversal as well. So what are some of the ways that you like to implement those spreads?
I was just working with a client literally yesterday who bought some Facebook stock. And
oh, geez. Hopefully he wasn't that 45 print.
We're not quite 45, no, but
wow.
Wasn't going well. And his outlook on Facebook stock was, hey, man, I'm going to hold this for a couple or a few years because I think in the long run it's a great play. But I think between now and the end of the year, I'm pretty concerned, and I need to limit my risk. And this guy didn't have a small position. I mean, this guy had a gigantic position. So we sat down and we talked, and it's really a very, very simple strategy. It was kind of brand new to him, and we kind of had to walk through a little bit, but just the traditional collar, which is basically the risk reversal combined with stock.
The risk reversal reversed in some ways.
Exactly, right. And so he owns the stock. So what he ended up doing is buying some puts in Facebook, close to the money, just a little bit out of the money, and selling some calls at the strike price where he originally bought it, and he ended up paying a couple of bucks. And his risk is protected. If the stock, he could lose maybe another literally about $2. And that's it. Stock can go to zero for all he cares. He's protected. But he's still got a bunch of room to the upside. If the stock retraces up to the price where he bought it, he can make all his money back. So it's a really, really great strategy. And, it's not one of these crazy, wacky trader strategies that, you try and impress people with at cocktail parties. Oh, yeah, I was doing this. No, this is your most conservative, investor-oriented strategy. This is a strategy that Mark Cuban was rumored to have used to have been one of the winners in the dot-com era. He was long all that. What was it?
All that Yahoo stocks eventually bought him, right? They acquired his broadcast.com.
Yeah, I think it was.
So I believe it was Yahoo.
Yeah. And, the company that he had, the Broadcom, he was afraid that it was going to tank like all the other .coms. He collared the position, and he was fine. The stock got creamed, but he didn't care. He was protected. It's basically a way to buy puts for insurance, but puts for insurance are expensive. So this is a way where you can finance that put. And man, I'll tell you, under the right circumstance, even for a very conservative investor, it's a great play.
Now, if you're interested in collars, listeners may remember we had Joe Burgoyne from the Options Industry Council on the show a few episodes ago, and I encourage you to surf on over to optionseducation.org. They have a lot of studies there, including one called, I believe, Tightening Your Collar or Loosening Your Collar, where they go back years looking at collars on the Russell and other indices and even other asset classes and seeing how collaring the index or the underlying compares to owning it outright across a variety of periods. And what they found was across the board, collars not only outperformed on a risk-adjusted basis, which is, they lowered volatility and generated decent returns or comparable to the overall underlying, but also in many scenarios they outperformed owning the underlying by itself, which is something that no one really anticipated. People think of collars as a very, conservative strategy for the most part. And so seeing that type of performance across a variety of asset classes was very interesting. So if you're interested in collars, by all means, check out what the OIC folks have and all their studies on collars, because there's a vast wealth of information waiting for you over there. And that's all we have time for today on our basic training segment. But hopefully we gave you a little taste of what complex spreads can do for you. And of course, we only scratched the surface of the types of spreads and the different varieties of the complex spreads that are available to you as an options trader. Hopefully we'll be able to get into more of those in future episodes of Options Bootcamp. But for now, it's time to dive right into our roll call segment.
Roll call! You boots listen up while today's guest speakers are announced.
All right, and welcome to Roll Call. This is, of course, the portion of the show where Dan and I welcome a guest from the world of Zecco onto the program to discuss some of the interesting developments over there on the Zecco options platform. And today's guest is Craig Pinkston. He is the Senior Director of Operations over there at Zecco. Craig, welcome to the program.
Thank you. Thank you very much.
I'm glad we could have you on the show. Craig, your voice is dripping with enthusiasm.
I love options.
I think you're overwhelmed with the opportunity to be on the actual boot camp. But, because this is your first time on the program and indeed on the Options Insider Radio Network, we'll give you a chance to give our listeners a little brief overview of your background in the financial and derivatives world and then how you became the Senior Director of Operations over there at Zecco.
So I've been in the securities industry for approximately 14 years now. I cringe almost every time I have to say that. But I started in operations at a small broker-dealer, and I graduated to the trading desk. And then I became head of risk management over there. And then I worked in compliance at a much larger firm for a while, and the opportunity to join Zecco presented itself. I having experience in new accounts, banking, and retirement and trading, as well as risk management, kind of made me a natural fit. I've been here for approximately 6 years almost.
Wow, 6 years. That's a long time, my man. So, Craig, let me talk to you a little bit about, just some of the things that you're responsible for over there. And as I understand it, you've got a great deal to do with risk mitigation, right?
We do. Yes, that is certainly one component of what my department does. Yep.
Why don't you maybe take a few minutes and tell us a little bit about Zecco and tell us what some of the ways that Zecco helps protect its option traders specifically are.
So first and foremost, we ensure that the option levels that are requested by the customers are suitable based on the financial information and the experience that they stated on their applications. That process is pretty rigorous and thoughtful, but we'd be remiss if we allowed a conservative customer with no experience to trade uncovered options. Apart from that, following the approval process, we've got a dedicated margin and risk team that monitors orders and trading activity on nearly a real-time basis.
Wow, that's great. Yeah, that's the kind of stuff that's really important. Now, you mentioned the margin and risk team. What are some of the ways that they help reduce some of the risks that customers can expose themselves to?
So, like I said, we review trades as they come across, and option trades in particular that exceed certain thresholds default to a queue that my team reviews, and they'll assess, the suitability and equity in the customer's account, and approve the trade based on those conditions.
Mm-hmm. Now, in 6 years, I bet you've seen it all as far as traders going out there and putting on positions, huh?
I have indeed, and so that's a great point. Apart from the approval process of the order entry platform, we have risk analysis queries that we run throughout the day to help us identify areas of concern based on price volatility and customer equity, things of that nature. On occasion, the team will indeed go and take an action on behalf of the customer if we have discovered a situation that presents an undue risk either to ourselves or the customer.
So tell our listeners this, and maybe what you can do is you can help make your job easier down the road. From experience, do you have any tips for customers that can help them avoid some of these risks so that you guys don't have to intervene?
Certainly. First of all, I'd say be thoughtful about what you're doing. Customers should really understand the risk and characteristics associated with options tradings. Don't overextend yourself. That said, with a proper understanding of those risks, options can be a great addition to any trader's arsenal. They can protect your portfolio and in some instances help you grow assets.
Well, Craig, we want to thank you for taking a little bit of time out of your day to join us today. This is, of course, a very busy day for you. Our listeners should know that we're recording on a day when the S&P is down about 32 handles. So I'd imagine there are quite a few of those trades and accounts piling into that queue for your review today. So we want to thank you for taking a few minutes out of your day to join us today here on Options Bootcamp.
Thank you very much. I really appreciate it. Indeed, it has been an active day. But I appreciate the opportunity, and I'd love to do it again.
All right, and that's going to do it for the roll call segment. And now we're going to dive right into our mail call segment.
Mail call. Time to look at questions submitted by our listeners.
All right, and welcome to Mail Call. This is, of course, the portion of the show where you get to take your tilt at the old windmill, and Dan and I will attempt to answer your questions, your comments, your queries about the world of options. And today's question comes to us via Facebook from Jason Cruz, and he asks, does the theta decay occur just at open/close, or is it a gradual decay throughout the day? Well, thank you for your question, Jason. That is a fantastic question. I could certainly see where it comes from. You know, if you watch options throughout the day, you watch how they perform, you watch their prices and their price movement, it certainly is very easy to come away with the impression that theta, or at least the bulk of it, occurs at those two moments you just described, the open and primarily the close, because that is where a lot of that tends to hit the tape. And so I could see why a lot of people coming to options for the first time would assume that theta is this binary thing that only occurs at the open or the close. But the truth is far more interesting and far more nuanced. And rather than have me drone on about it at length, Dan, we have you here on the show, and of course you did write the book about Greeks. So by all means, sir, why don't you walk Jason through the vagaries of theta, sir?
Sure. So for all you other listeners out there, this is at the heart of Jason's question. It's in regard to what's called time decay. As time passes, options get cheaper, all else held constant. Now, how much cheaper? Well, that's specifically measured by the Greek theta. Theta tells you how much an option price changes as 1 day passes. So now, Jason's kind of getting down to the nitty-gritty here. He says, okay, I get it. Options lose value by the amount of their theta, but exactly when does that theta come out of the option? If the theta is 2 cents and the option's 40 cents now, when does it become 38 cents? When does that theta come out? The beginning of the day, the end of the day, some other time? Well, what you need to understand in order to intellectualize the answer to this question is that option traders are clever. If there was a point during the day when the whistle blows and the time decay comes out, everybody moves their dates ahead in their models, making the options cheaper by the amount of theta, then guess what? Some of these smart professional traders who are well capitalized, they would get in there and they would sell the options right before the whistle blows. And then when that theta comes out, the 40-cent options become worth 38-cent options. Well, they would sell them at 40 right before that whistle. And then right afterwards, they'd just buy them right back at 38 and make a 2-cent profit. And they would do that on thousands and thousands and thousands of contracts. And you know what that would do? All that selling pressure would force the price lower before the whistle. And so then everybody would kind of get in the habit of knowing that, well, it happens before the whistle. And so then the really, really clever traders, they would sell 2 minutes beforehand, right? Everybody, trading is very competitive. Traders are smart and they're competitive and they want to win. They want to get ahead of their competition. So it can't happen at a specific period. That would create an arbitrage situation for the smart guys. So what it does is it just kind of comes out when it comes out. Now, part of this has to do with how professionals, market makers, trade. They're gamma scalpers. Maybe you guys have heard of this before. If they own options, when the stock goes up, they have to sell stock. When the stock goes down, they have to buy stock. And basically, when you're long gamma, you kind of have this little bit of a money-making machine. The more the stock goes up and down, the more money you're forced to make. But on the flip side of that is theta. If the stock doesn't move, you're going to lose money because you have to pay theta. And with market makers, I've had days when I was a market maker where my theta was $2,000, $3,000, $4,000 a day. It's serious business. So you can't just sit there holding these options if the underlying stock isn't moving. So that's what forces the professionals to take the day out during the day. If it's starting to look like they're not going to be able to cover their theta by scalping gamma, then they say, hey, you know what? I'm going to dump these. I'm going to move a day ahead and I'm going to make my options just a little bit cheaper to attract buyers so I can sell them to somebody because I don't want them. So that's kind of how it works, Jason. I kind of gave you the long answer, but hopefully this will be some fodder for you to think about a little bit and really understand exactly how the situation works. And next time you're trading and you're thinking about, I wonder when these options are going to get a little bit cheaper by theta, now you know how and why that happens.
Theta is an interesting beast, and Jason's question really hits the nail on the head there where, when does this happen? And that's really the truth, is it comes out when it comes out. People often make the mistaken assumption when they look at theta, theta is X. That means that theta is this consistent linear process. This will lose X% every day like clockwork at this period and this period and this period, and it works in this completely linear fashion. And theta isn't like that. It definitely has fits and starts and leaps and gaps. And if you look at it as just this linear progression where every single day you're going to do this at this certain period throughout the day, and by an hour later you will have lost X% more of the decay, it doesn't really work that way. It is such a ebb and flow of the paper flow and what the customers are doing, what is going on in the broad markets, and also other ancillary events that could be impacting you. We see a lot of premium sellers, a lot of retail premium sellers make the mistake of coming in and trying to sell a lot of premium before earnings, way before earnings, trying to collect all that decay. And they don't realize that that decay that is happening is actually being offset by an increase in vol going into the earnings event. So that makes it very difficult if you're a premium seller to collect that premium before the event. You have to wait until the earnings announcement is over, in which case that volatility goes away and all that decay that's been kind of built up and hasn't really eroded yet comes flooding out in one massive flush of decay. And so that's a perfect example of a non-linear type of decay process where the decay still occurs, but it's by no means a very predictable and linear process. It really is when it comes out. Same question we get a lot, a variation on Jason's question is, when does the weekend first start coming out? You're going into a long weekend like we had last week, Dan, with the Memorial Day weekend. And people ask, when does that decay start coming out? And the answer, again, is the same as whenever it starts coming out. Sometimes you could see aggressive market makers and customers often going into a long weekend where perhaps it's a very quiet week, there isn't much going on. They can start taking that theta out into Wednesday even. You know, you can start seeing those options starting to come in because paper is hitting them. The market makers are lowering their bids as a result, and the theta just starts coming out at that point. You might have an example of what we saw a few weeks ago, or actually a few months ago, where we had the non-farm payrolls coming out on Good Friday when the market was closed. So as a result of that, even though it was a long weekend, everyone kept their powder dry. No one wanted to sell a ton of premium going into that event, particularly with the market closed and you couldn't really trade around it. So that we saw the weekend didn't really come out that weekend. It came out on Monday the following week. So there's a lot of interesting elements that go into theta and when theta decay actually occurs. And it's an interesting beast. Dan and I have both been on the floor for a number of years, and we kind of learned it the hard way how it works. But even then, it's still a head scratcher to us sometimes exactly when this theta is going to occur and in what form and shape it's going to take. So yeah, theta, very much an interesting beast and a very interesting question. And I think one that's definitely worthwhile for a lot of our listeners to ponder as they're thinking about diving into the options game and perhaps picking up some of those complex spreads we discussed at the top of the show. Any more tips or tricks here for Jason before we close out the mail call segment, Dan?
Buy low, sell high, baby.
Well spoken, sir. That is good information for any potential options trader. All right. And with that, we're going to close out our mail call segment. And that's also going to do it, unfortunately, Dan, for this episode of Options Bootcamp. I want to thank you, sir, my co-host, my partner in crime, for joining me on the show yet again. 6 episodes down now, Dan. Can you believe it?
Holy moly, has it been that many?
Yeah, it's been 6 episodes already. We're cranking them out. Hopefully many more to come here in the old Options Bootcamp program. But before we go, Dan, what is going on over at Market Taker Mentoring that may perhaps interest our listening audience?
Well, let me tell you, Mark, it's busy as heck over here, man. Been having a lot of new students joining and signing up, and been really, really exciting. Some great things are happening over here. And I know that some of it is because of you listeners. And I was thinking about this. I would like to offer a little bit of a special for those of you who are interested in one-on-one coaching. I will offer a $200 discount for people who contact me and reference this show. So if you are a fan of this radio show that you're listening to right now, you give me a call. Send me an email at dan@markettaker.com, and I'll hook you up with a $200 discount, and we can take your option trading to new heights, and you can really get some one-on-one attention.
There you go, listeners. Drop Dan a line over at markettaker.com and tell him you heard about it on Options Bootcamp, and those glorious savings will be heading your way in no time. You can hear Dan illuminate all kinds of great examples, like the collared example we just discussed on this show, and many more in your own private one-on-one session. But yeah, so listeners, by all means, take advantage of that offer. That is a great offer. And check out what Dan and the boys over at Market Taker Mentoring have to offer. And if you're interested in any of the topics we discussed on this show or any of the topics we discussed on previous episodes of Options Bootcamp, then by all means, surf on over to theoptionsinsider.com. You can find previous episodes of this show, as well as all of the other programs that are available on the Options Insider Radio Network, as well as breaking news from the options market, education, analysis, unusual activity, all sorts of fun things and fun topics. If you're into options in any way, shape, or form, chances are we have something for you over there at the website. And of course, you can also find all of our programs in iTunes and Stitcher and anywhere else that fine podcasts are purveyed. Just search for Options Insider Radio. And one more thing, listeners, you should, of course, check out Zecco.com/bootcamp to find out more about what's going on over at Zecco and the different offers they have available just for listeners of this show. So if you're thinking about sticking your toe in the options waters, then check out what Zecco has to offer you over there at Zecco.com/bootcamp. And that is going to do it for this episode of Options Bootcamp. We, of course, want to thank all of you out there for downloading and streaming and subscribing to this program and making it such a success. And Dan and I will see you next time right here on Options Bootcamp.
This episode of Options Bootcamp was brought to you by Zecco, quite possibly the best value in stock and options trading. If you'd like to submit a question for the hosts, visit facebook.com/Zecco and post it on the Zecco fan page. Zecco reminds you that options involve risk and are not suitable for all investors. Please read characteristics and risks of standardized options at Zecco.com/ODD. Multiple leg option strategies involve additional risks and multiple commissions and may result in complex tax treatments. Please refer to the spread trading disclosure found in the options agreement and disclosure document at Zecco.com/disclosures. The Greeks represent the consensus of the marketplace as to how the option will react to changes in certain variables associated with the pricing of an option contract. There is no guarantee that these forecasts will be correct. Technical and other supporting data on this program can be supplied upon request by contacting editor@Zecco.com.
Electronic trading has inherent risks due to system response and access times that vary due to market conditions, system performance, and other factors.
Options Bootcamp is produced by the Options Insider Incorporated in association with Zecco Holdings Incorporated.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.